Welcome to Rad Academy. Today we are going to talk about time value of money. So if today is your first time on the channel, please subscribe to the channel Rad Academy for more videos. Today our topic is time value of money. So under this we are going to look at the interest, then we look at the simple interest and also the compound interest. So when we talk about first, let me explain the time value of money. The idea about time value of money is that money today is worth more than that same amount of money in the future. That is the idea about time value of money. Do you get it? This is because money you have now can be invested or used to earn more over time. That is, if you invest money today, you are going to make interest on it tomorrow. Do you get it? So you can invest today's money and earn interest or profit. So that is the whole concept or idea about the time value of money. The money you have today can buy more goods than in the next 2 years. So if you have 100 cedis today, you can buy more goods than that same 100 cedis in the next 2 years will buy fewer goods than today. That is the idea about time value of money. So now let's move on to the interest. When we say interest, when a person opens a savings account with a bank and deposits money into that account, the bank will pay the person some amount of money because the person is saving with them. So that amount that the bank pays to the savings account holder is what we call the interest. So, for instance, if someone opens a savings account and deposits 500 cedis in it, and at the end of the month, the bank credits the customer's account with 20 cedis, identifying that it is interest on the savings. So that 20 cedis is what we call the interest. Similarly, if a person borrows money from a bank, say loan, the bank will expect that the person pays back the money with the money he borrowed and an additional money. That is what the additional money that is going to pay in addition to the money he borrowed is what we call the interest. So for the interest, it depends. It could be an income or it could be an expense. So if it is an investment that you are making and you are receiving interest, then it is an income. But then if you are borrowing money and you are paying interest, then it is an expense. So one thing that you have to know in this world is money is not free to borrow. When a person or an entity borrows money, the lender will definitely charge you interest because if I borrow you 100 cedis today, the assumption is that if I'm going to get a book 100 cedis today and I lend you that 100 cedis, by the time you come back to repay me my 100 cedis and I decide to use that 100 cedis to buy that same book which I wanted to buy some let's say some months ago, the price will not be still 100 cedis. It means I will run at a loss. So what I'll have to do is I'll make sure you pay 100 cedis, you pay interest on that 100 cedis so that as at the time you are paying back my money, I can still purchase what I wanted to purchase. Mostly that is why we charge interest. If a bank loans you 2,000 Ghana cedis and the bank is saying pay these 2,000 Ghana cedis within 1 year or 2 years, the bank is going to charge you interest because the bank is assuming that by the time you finish paying this 2,000 Ghana cedis, the value of the 2,000 Ghana cedis will still not be the same after 2 years. Therefore, I have to let you pay more than that 2,000 Ghana cedis in order for me to get that same value again as at the next 2 years. That is why we charge interest. So that is the interest that we have. Now let's move to the definition of interest. When we say interest, it is the extra amount of money. It is the extra amount of money. So extra amount of money is an extra amount of money. An investor, so extra amount of money. An investor receives after investing a certain sum of money at a certain rate for a certain time. So if I invest 1,000 Ghana cedis, that is the sum of money. And it could be that the rate could be 10%. So if I decide to invest this 1,000 Ghana cedis, let's say I want to use this 1,000 Ghana cedis to buy treasury bills. This 1,000 Ghana cedis is the sum of money. And let's assume the rate for the treasury bill is 10%. So this 10% is that certain rate we are talking about. And I can decide that I want to receive my 1,000 Ghana cedis plus my interest after, let's say, 6 months or 1 year. So the time period is what we are saying, the certain time. That is what we can explanation for interest. And also, interest can also be the additional amount of money paid by the borrower to the lender for the use of money loaned to the borrower. So here, in the second definition, we are talking about when you borrow money, that is, when you borrow money from the bank, and the additional money that is added to the money that you borrowed is what we call the interest. So the interest could be on an investment, or it could be on a loan. Okay, so the total interest associated with a loan is the difference between the total repayment and the amount borrowed. So for instance, let's say you borrowed 2,000 Ghana cedis from a bank. So this is the amount that you borrowed. And at the end of 1 year, the total repayment was 2,500, meaning there was an interest, 2,500, meaning there was an interest of 500 Ghana cedis. So this 500 cedis, we had this 500 cedis from the total repayment, which is the 2,500 minus the amount you borrowed, which is what, 2,000, which is going to give us 500. So this 500 is the interest on this 2,000 Ghana cedis. Yes, this is the interest on the 2,000 Ghana cedis. Let's move on. Then let's move to the simple interest. Simple interest. Let's move to the simple interest. So when we talk about simple interest is where the annual interest is fixed. The annual interest is fixed of the original amount borrowed. It's fixed on the original amount borrowed or invested. That is the principal. That is the principal. So that is the simple interest. So simple interest is the interest that is not compounded. when we say the interest is not compounded, what we mean is the rate is calculated on the principal only. So if the investment is for 3 years and the rate is 10%, the 10% will be calculated on the principal. So let's assume the principal is 1,000 Ghana cedis. The 10% will be calculated on the principal, which is 1,000 Ghana cedis throughout the period, 3 years. The 10 calculate that is the fixed interest rate. That's the fixed percentage that we are talking about here. So that amount will be calculated on the principal only for that particular period of investment. So let's say the investment is for 3 years. We are going to calculate the 10% on only the principal only throughout the year or throughout the period of investment. That is what we mean by it is not compounded. Let's take this example. We said a person borrows 1,000 Ghana cedis at 10% with principal and interest to be paid after 3 years. So here, our principal is our 1,000 Ghana cedis. Our principal is our 1,000 Ghana cedis. And our rate is what? 10%. And our time is 3 years. Our time is 3 years. So let's look at the solution we have here. So the amount we borrowed at the start of the year was 1,000 Ghana cedis. So the interest that we are supposed to pay for the first year is 100 cedis. That is the 10%. So 10% on the 1,000 Ghana cedis. So we cancel this two, we cancel this two. So 10 by 10 will give us what? 100. So this 100 is the interest that we are supposed to pay for the first year. Then we move to the second year because they are saying that we are supposed to use 3 years to pay that amount we borrowed. And every year we're going to pay 10% on the principal, which is the 1,000 Ghana cedis. So the first year we're going to pay 100 cedis as interest, and the second year Ghana cedis. That is the simple interest. The interest is always calculated on the principal only. And then to the third year, 1,000, then we get 100 cedis. So if it is for 5 years, you're still going to calculate 10% on 1,000 cedis a year. At the end of the 3 years, we are going to pay 100 cedis plus 100 cedis plus 100 cedis, and you're going to get 300 cedis. So at the end of the 3 years, we are going to have 300 cedis interest. And the amount we borrowed plus the interest we are supposed to pay. So that is the principal plus the what interest give us the amount. And that is what we are having here as the 1,300. That is what we are having here as the 1,300. Okay, so let's move on. Now here we have the simple interest formula. The reason why we are bringing this simple interest formula is, see, we are in the previous question, we are calculating the percentage by calculating 10% on the 1,000. So if, let's say, you are going to use 20 years to repay the loan, are you going to calculate 10%? 10% on the 1,000 first year, second year? I'm going to repeat this same calculation for 20 years. That would be very, very tedious. That is why there's this formula. And the formula is I is equal to P times R times T all over 100. That is the interest. That is if you want to find the interest. This is the formula that you are going to use. And if you want to find the amount that you are going to pay, the amount that you are going to pay at the end of the period, then it is the interest plus the principal. So where this A is the amount to be paid, the I is the interest charge, and the P is the principal. That is the amount borrowed or invested. The R is the interest rate, and the T is the time or period that you are going to use to pay your the amount you borrowed, or the time you are going to use to invest. So that is, so this rate, this 100% that you are seeing here is the rate. So you see, normally they give you rate as 10%. So if it is 10%, um this 100 that they are seeing is the percentage. You get? So if you don't want to bring the percentage, you can likewise, so let's assume this is the percentage. Let's say we have a principal of 1,000 Ghana cedis and we have a time of 2 years. So I is equal to 1,000 times 10. Then this percentage over 100 times what? 2. It's still the same thing. So it's the same thing that we, but then if you don't want to bring this 100 cedis, you can just say I is equal to 1,000 times 0.1 times what? 2. So this is, so in some books too, you can see that the formula is P times R times T. You don't see the over 100. This means when you are given a percentage, you change it to decimal. So this is the formula. That is when you are given a simple interest question and you want to use the formula. This is the formula that you are going to use. Very, very simple. So I want us to take this question. So I read the question. Kwame invests 2,000 Ghana cedis in a savings account that pays a simple interest rate of 5% per year. How much interest will he earn after 3 years? Also, what will be the total amount in the account at the end of the 3 years? So looking at this question, our principal or the amount that we invested that is our P. So first of all, we quote our formula nicely. So since it is simple interest, we are going to use this formula. Where we have our principal to be 2,000. Then we have our rate to be 5%. Then we have our time to be 3 years. So we have this information. So when we have this information, we just need to put our figures into the formula. Then we can get the interest for the 3 years. So we have to be 2,000. Then our rate is 5%. So 5 times the time 3, then all over 100. So we can cancel these two. Then we multiply the 20 by 5, then by 3. Then we get 300. So we are going to have 300 Ghana cedis as our interest. So the 300 cedis is our interest, and they are asking us how much will be in his account at the end of the 3 years. The amount that will be in his account is equal to the amount that was invested, which is the principal P plus what? I. And the amount he invested is what? 2,000. And the interest after 3 years is 300. So when we add this, we will get 2,300. So we have 2,300. So that is the amount that will be in his account at the end of the 3 years. So that is all for this. So we are going to end here for the simple interest. I'm going to continue in my next video where we are going to talk about the compound interest. So subscribe and click on the notification bell so you get an update when the new video is uploaded. Subscribe to Rad Academy for more videos. Bye bye. See you in my next video.